Hi, everybody. Today I'm going to talk about crypto taxes. We've got tax day coming up on Monday. So if you're watching this, I've got a bunch of different pieces of information here that are going to help you navigate this tax season. Before we begin, I want to give a shout out to Ledin. Ledin is one of my sponsors. It's one of the best places to borrow against your Bitcoin using it as collateral or lending it out and earning a yield. Okay, let's go ahead and jump on in. So again, crypto taxes. Tax day is tomorrow. You're definitely going to want to go take some of the lessons from here and go talk to either CPA. Again, I'm not I'm not a financial advisor, but these are just some of the talking points that are going to get you started to understand crypto and taxes. All right, cool. So this newsletter or this video might look familiar. And by the way, this newsletter that I write comes out on Thursdays. It's called The Held Report. On Sundays, I talk about it on my YouTube channel. But yeah, it might look familiar because I talked about this at the end of 2021 because you could take advantage of something called tax loss harvesting. What that means is you would realize your losses and that could offset your gains. But I'm coming out with this video because it's right before tax season and we need to get people up to speed on crypto and taxes. So there's some other stuff as well where like there's an update on how staking is taxed that I cover in here. And then this is only for US customers. It's not for global. I think it would take me a lifetime to go write up everything about global crypto taxes. So let's start with the basics. How is it taxed in the US? Well, it means it's taxed as a capital asset. And so every single buy or sell counts as a taxable gain or loss. And now in the beginning, it was a little bit easier. You had Bitcoin and a couple other crypto assets, and it gets a little bit more complicated as we went down this crypto rabbit hole. So here's a couple different ones that I want to call out. Forks. So the IRS takes the position that hard forks are a new currency and they're akin to a dividend for tax purposes. So that's kind of an interesting way that they phrase that or look at that. Airdrops. The IRS takes the position that you're taxed at the fair market value when you have domain and control of airdrop tokens. So what does that mean? That means if you have like a self-custodied wallet and you have control over that private key and you received a airdrop, then that's likely a taxable income, which is pretty wild. That also assumes that there's a market for the asset as well. But that's something that I think a lot of people don't think about, and they get all these airdrops and consider it free money, but it's actually taxed as income. And then DeFi, you've got like a lot of different activities in DeFi going, and then you got lending. So lending out your crypto, which generates interest. And this is usually taxed as income. You've got receipt of incentive tokens, and this is also taxed as income. And you got transfer of tokens into liquidity pools. And I think a lot of people make this mistake. This is kind of a big one I've seen when I've tweeted about these topics. A lot of people were surprised by this. When you deposit coins into a liquidity pool, that's a taxable event. So let's say you put $1 million into a liquidity pool to earn X amount of yield. As soon as you put it into the pool, that's considered a sale of your asset. So that's pretty wild. And then also, you can't really call this interest. So the IRS may not take your definition of the income or the yield that you generated as interest. It could be considered something else, which interest is taxed in a slightly different manner than other types of income. So yeah, it's definitely one of the most, DeFi is one of the craziest, most rapidly evolving sectors. And they've yet to rule specifically on these things. However, there are existing laws or existing constructs that they use to develop these. So these aren't too big of an extrapolation to interpret it the way that it's interpreted. And by the way, most of the content here comes from the TaxBit blog. I'll cover this a little bit later. So if you're ready to do your taxes, TaxBit, one of my partners, is definitely one of the best places to go do this. They're rated one of the top tax companies in this space. So we'll get into that in a minute. But a couple other things, NFTs. But since NFTs are quasi-collectibles, the IRS could tax them like collectibles, which are subject to a 28% long-term capital gains rate, regardless of income levels. And so, if we look at the definitions of collectibles here, it could be perceived that NFTs are collectibles. And then by the way, that's long-term capital gains. So 28% long-term capital gains is pretty damn high. In any period under 1 year would be short-term capital gains rate, which is ordinary income tax. So, it's really, really tricky here where, when people are trading these crypto assets, like in the crypto world, they're super fluid. You can go trade between back and forth things super easily. You're staking, you're lending, you're providing liquidity to liquidity pools. But at the end of the day, there's a lot of nuance to how these things are taxed. Crypto to crypto transactions during the 2017 bubble, a lot of people didn't think that these were taxed. They definitely are. You're selling one and buying another. And so this is a capital gain or loss and will be taxed based on how long you've held it for and how much, what your cost basis was will determine the total value. Earning crypto, getting paid in crypto is exactly like getting paid in fiat. I don't understand why people don't think this is considered income. If that loophole is that easy, then people would just get paid in anything other than dollars. So yeah, if you get paid in crypto, that's taxable income as soon as you receive it. Mining. So mining, you essentially, you're spending that upfront capital, and then you receive Bitcoin as income. And then whatever the delta is between when you received the Bitcoin as a miner and when you sold it is a capital gain or loss. So yeah, that means every single, if you're part of like a mining pool, you have to, every single inbound Bitcoin transaction that comes to you will be considered income. There's some nuances around how do you depreciate, for example, you can depreciate the mining equipment itself. That's a whole different rabbit hole, and I don't want to go down that yet. Hey everyone, I want to pause here real quick to give a shout out to one of my sponsors, Choice. They're rebuilding retirement accounts for Bitcoiners and enabling you to trade real Bitcoin, crypto stocks, and more in a single tax-advantaged account. Thousands of Bitcoiners, myself included, have already signed up to start investing. I spent a long time looking for a solution like this. I'm super glad I found Choice. Check it out at www.choiceapp.io/held. And the link is below in the description. Oh, and one more thing. I wouldn't be working with Choice if they didn't let me hold my own private keys. Staking. So while there is no specific, and this is a big one, I think a lot of people have misconceptions around staking that are pretty wildly different than what the reality is. So we have tax guidance from the IRS on mining income. And so people with staking, look at that and they consider that income as well. Now, some stakers hypothesize that, hey, well, we're getting new assets, like newly minted assets plus, plus the fees. So maybe part of that isn't taxable, or maybe just the fee portion is taxable. For example, the creation of new property or the new assets that are created through inflation, they thought it might be under this clause of creating new property. In that case, there would be no taxable event until the sale of property, because right now with staking, and if you have a staking protocol that's inflationary, you're losing, just to keep up your purchasing power, to maintain your percentage of the total number of coins, you have to stake. But if those are being diluted and you're paying taxes on that, you're slowly eroding your stack over time. Ben Davenport had a really great article called "A Stake in the Heart." It's like 1.5 pages long, really great, talking about this issue where these staking rewards can slowly erode your stack because you're not being able to maintain your purchasing power. So in 2021, a couple filed a lawsuit against the IRS because they were staking on the Tezos network and claimed that, hey, our assets here are actually not income. This is a generation of new property. So the news recently broke that the couple and the IRS settled, and social media was abuzz that this precedent had been set, but that isn't accurate at all. This doesn't really mean anything until the IRS has made rules, and the couple's argument is extremely unlikely to win in court. So all the tax experts that I've seen talk about it are basically like, no, this will be considered taxable income. So by no means is that a victory. By no means has the IRS ruled on anything. There's also a deeper dive here into the topic. So yeah, that was kind of like the biggest piece of news I think a lot of people were looking forward to, and they claimed it as a win. It is not a win. It is not definitive at all, and most likely will lose in the long term, to lose the argument that staking rewards are not taxable gains. So staking rewards are most likely taxable, like taxable income. All right, so the next couple sections, these are some of the basics of, like, no matter what asset you have to do these things to, like, look at, to track your cost basis, basically how much it cost, and you need to track which ones you sold. So cost basis equals original cost when you bought the asset. When you have multiple units of the asset, say 3 Bitcoin or 4 shares of Uber, you need to track which exact units you sold. So it's typically better to dispose of an asset, sell an asset that is a higher cost basis, because that reduces the amount of gains that you've realized. So there's a couple different ways, and before the 2019 guidance by the IRS, you could use all of these in a reasonable manner to talk about your different tax lots and how you disposed of them. But the IRS's new guidance specifically allows for only 2 cost basis methods, which are FIFO, first in, first out. So the first assets you bought are the first ones out. That maximizes your taxable gains typically if the price of the asset's moving up over time. So that sucks tax-wise because you pay the most possible. And then there's also specific identification. Specific identification is the most advantageous one. It's just the most hard to calculate. So what you do is you specify which exact coins that you want to sell. So you can easily select the highest cost ones, and that reduces your taxable liability. So that's pretty cool, but it does take a lot more effort. And these screenshots, by the way, are from TaxBit, the tax tool I was talking about. Now, you've calculated your cost basis and the delta between your cost basis and what you sold it for. Well, how much taxes do you pay on that? In the United States, they distinguish between long-term and short-term capital gains. If you hold a crypto asset for 1 year or less, your transaction will constitute short-term capital gains, and that is added to your income and is taxed at ordinary income tax rate. Long-term capital gains are subject to how long. So yeah, it's 1 year plus, but then it also is based on your income level. So they're either taxed at 0%, 15%, or 20% if the assets have been held for more than 1 year. You can go check out those income levels here. It's easily Googleable as well if you just check out like long-term capital gains levels. And then losses. So the difference between your capital gains and losses is called your net capital gain. If your losses exceed your gains, you can deduct the difference on your tax return, but only up to $3,000 per year, which really sucks because this number, 3,000, hasn't been adjusted for decades. So essentially, the maximum you can offset your income with is $3,000, no matter how big your loss is, even if your loss was $1 billion. Now, if you had $1 billion of gains, then those would net out. But let's say you have a giant loss and then you never have, another large capital gain again, those never really offset, which sucks. And so, part of what I covered here at the end of the year, which I'm not going to spend too much time on, is tax loss harvesting. So within the same calendar year, if you've got a bunch of gains, but then maybe some of the assets you bought have losses, but you just haven't sold them yet to realize that loss, you can sell the asset, realize the loss, and that'll offset some of your gains. Now, in the normal equities world, that's called a wash trade, and that's not allowed to do. But in the crypto world, it's widely agreed upon amongst a lot of tax experts that that's probably okay to do. Again, none of this is tax advice. This is meant to start a conversation. You should talk to a tax advisor, talk to someone who's an expert. But what's really cool is that it minimizes the taxes that you're going to pay. All right, so I covered all this stuff, and you're like, shit, Dan, I've been doing a bunch of NFT stuff. I've been buying and selling. I've been staking. How am I going to do all this? Well, you got to pick the right tax software. None of them are perfect. I'm not going to say that any of these are going to perfectly do your taxes for you, especially if you got a bunch of on-chain stuff, you've got CeFi stuff. But one of the best tools out there is TaxBit, and TaxBit's one of the partners of mine. I've known these guys since I met them at a conference booth in 2018. These guys have built $1 billion crypto tax company, and they've been crushing it. They partner with PayPal, Gemini, BlockFi, OKCoin, CoinList, etc. They're widely integrated with almost every single exchange out there, and they can process on-chain DeFi stuff too. So here's a sneak peek at their product. Really slick, really easy to use. What's cool too is that they have different tranches of services, but their entry-level tool, so if you've got some basic accounting needs, is free. And so the link is below in the description if you want to check that out. But yeah, it's basically free, super easy to use. And then if you want, one that's a little bit more advanced, use the promo code DHELD, and that'll get you a discount on like the higher level tier products if you have more like complex needs. What's cool too is with TaxBit, you can monitor all of your assets over the year. So, it's not just a tax season thing. It's something that you can use this dashboard to keep you updated on all your assets. And then also at some point, if you need to sell something like buy a house, you can go and find the most minimal taxed sale. For example, you might find your highest cost Bitcoin to go sell or highest cost whatever asset. And so they do a really good job of like having that all very transparent and easy to navigate. Hope you enjoyed this deep dive into crypto taxes. I know it's one day before taxes are due. You can always file an extension, get more time. But with this, use TaxBit. It's a fantastic tool to go reconcile some of this information and then bring that information over to a tax CPA. Definitely talk to an expert about this. This video is meant to kickstart the conversation. Hope you enjoyed. If you'd like to throw me a comment or throw me a like, helps with the algorithm, helps get this more out to more people. All right, cheers.